I'm the moderator tonight, and I'm a serial entrepreneur, former Accenture IT and Accenture Strategy. I've got my DBA from Harvard Business School, and I run an innovation and entrepreneurship center at Jain School of Global Management. So tonight is all about scaling up, and we'd like to take the perspective tonight of both the founders and the funders. So can I ask you three, please, to start with the founder perspective? You guys fund them. What are you looking for? How can they get your attention and get themselves funded? Chris, I think I saw your little square light up with a yellow frame. You want to start?
So for the founders, the way to get investor attention typically we find is the question is, how do we reach them, right? In today's day and age, what happens is if you approach them cold, you may get lucky, and when they work through all their emails, they'll, if it's interesting, they'll get to you. But one of the best ways is to go through a fellow investee of an investor and then describe to that investor how you are attacking a problem that is so large and so unique, because investors really looking typically for that 5 to 10x, and the way that they filter through the deal flow is through some warm introduction. So look for an investor, make sure you study what they look at to get the good fit, and typically the best way to go through is through a fellow investee company of that investor.
Beautiful. Ashish, how about you?
Yeah, I think this is one of the places where I think several entrepreneurs make a mistake. They see fundraising as a one-time activity, and when they're kind of down to last 6 months of runway, or sometimes even 3 months, then they will call one of the bankers or call desperately some of the investors they know and say, look, I'm doing great, and here's my plan, and I need to raise money. I think in my view, the founder, amongst all other things, or one of the founding team, has to devote time to be on continuous engagement with investors, not pitching, but building relationships, telling your story, taking feedback on how market is responding, and making it a process than an event. And I think that's very critical. Other than that, I think there is obviously, depending on which stage you are, the fundraising pattern and fundraising requirements change. If you're an angel, you're just selling yourself and your team and a big idea. As you progress, that remains, but I think more maturity is expected of your product, your competitive position in the entire industry, your go-to-market, feedback from customers. So I think every stage that changes, and I think it's very important for founders to understand that what worked last time may not work this time again. So unless you are in constant touch with investors and telling your story, taking the feedback, you will not be ready for the next round of pitching.
Good. So it's all about relationship, and if you're going to engage funders, you're going to have an angel round, you're going to have a Series A, a Series B, a Series C, and so forth. It's a whole process, not a panic button. John, you had some really great advice too last time we spoke.
Yeah, I agree with everything that my co-panelists just said. I would just say directly to founders that we have to read a lot of business plans, we have to sit through a lot of pitches. And for me, after 8 hours of listening to product-based pitches, I'm usually pretty brain dead by that point and pretty disillusioned. And so what really wakes me up is when someone walks in and says, hey, I have a vision of how I'm going to change your world. And that always wakes me up. And then I go, well, how are you going to change my world? And they may be changing the world they may be using leftover electricity from the grid to mine for Bitcoins or something, or they may be filtering water in an entirely new way that's going to impact 164 million people. But when you paint a vision for investors, that works for you two ways. It helps provide an understanding of how big the market can be. But quite often, a lot of investors are people like me towards the end of their business life that have a particular passion for certain areas that they're personally interested in. I just got pitched today on an alternative protein project, and I know exactly where to send that because a friend just set up an alternative protein fund here in Singapore because that's their personal thing that they want to invest in now. They want to change the world by accentuating investment into alternative protein and getting rid of the current protein that we're using. So I think it's super important that founders put a vision across. Like, don't just sell me a Nokia, sell me an iPhone, gosh darn it. Yeah, sell me the next generation of something that I can get excited about, because anyone who's watched America's Got Talent, sorry to pull this down to the lowest level, but anyone who's watched that show knows that 90% of it's absolute garbage. And yet one guy walks out on stage and they sing in this beautiful operatic voice, and it's so different and so inspiring. And so you want to be that guy that day in the venture capitalist office, being that opera singer on stage that's really the inspiring guy that's got a vision that we can all buy into, because that's the fun part of what we do, right? Is finding that guy or gal that's got a vision for how they're going to change things.
Beautiful. And I love how you put it when we were talking earlier. Grab me on slide 1.
Yeah.
If you wait till slide 10, you've already lost me. That was beautiful.
We've all got those stories about slide 10 that happen like 1 out of every 300 plans, where someone suddenly announces that they have $38 million in revenue that they forgot to tell you about on slide 1. So we've all had that experience. But generally for me, if it's not on slide, forget the opening slide, like the holding slide. If it's not on that first slide where you're explaining it, I'm probably not going to get it. All right. So I think that first slide where it says in one sentence what you do and who you sell it to is just so important.
And I love that you brought up the alternative protein story, if you will. I'd like to hear from each of you a particular story of a particular startup that grabbed you and why.
Chris, I think you're starting out.
John, you can run with the alternative protein and say, I've done my
I'm already
or
in.
you can give us another one.
Yeah.
Chris, you've been called on apparently.
A-commerce is the region's largest e-commerce enabler, and it will list in the TiE Stock Exchange for around $700 and $800 million this year. We and I myself was lucky enough to be an investor, a board member, and their banker when we had a fund associated with KKR do their Series B. And when I met Paul Scherkel for the first time in Malaysia, and he was talking about e-commerce and what he wanted to do with a-commerce, what he hit me is, it's a jungle. Everything's so messy. And we will help the brands navigate the Southeast Asian ecosystem. We know this place like no other. We're silly enough to do it. We love pain. And just the level of passion to which he described the problem, and just in his eyes that you knew you had to get away from, him and not get in his way and write him a check. It was just magic. And he was actually one of the guys that, got me really excited about the Southeast Asian ecosystem, because, we just love it when we see these founders that are using technology to solve a problem today to create a better world for tomorrow. And it was like, wow, that's it, done. And so people have different thoughts about it, but for me, in this game, I find that investors actually relate on an emotional level. They buy the story, they buy the conviction, and then the due diligence is just justifying it. And that's when the numbers and all the other bits and pieces come from. There's different schools of thought, but that's what I've seen.
Fabulous. Ashish, do you have a favorite story?
No, that's frankly a question completely you tripped me on. I really don't have an answer for that, because I don't have a favorite. It's very hard for me to pick one. We have invested in almost 25 companies over the last several years, and I think I'm just passionate about so many of them. And what's been really incredible for me is to see the range of fantastic founders. Some of the most exciting ones I can tell you is somebody who is sitting in India, who is trying to transform the dental labs business in the US. And he's a Sikh, and he's getting, sort of mid-market, small family-owned businesses to sell their digital labs in the US and then come work for him. And of course, share the wealth and grow accordingly. And at the same time, transforming the industry digitally, bringing 3D printing and bringing like oral scanners. Now that's fascinating. That's a skill that very, very few people can do in a completely different environment. I mean, acquisitions are hard anyway. Roll-ups are even harder. And here is the man sitting in a completely different cultural context, going and acquiring companies and working with people, and successfully so. So that's kind of fascinating. I mean, the way some of the founders reacted during COVID, when supply chains were down, your cash in the balance is 1 month, and your fundraise was going well, and you're completely knocked down. And the way they reacted, the way they rallied their teams together, the way they found alternate ways of generating cash flows, was just really remarkable for me to see. And I really enjoyed it and respect them for that. So there are lots of businesses. I mean, we have a business which is basically helping Facebook groups, admins to monetize and to give brands the visibility into Facebook groups. And, before we know it, they have access to 300 million Facebook users. Now, how can you not get fascinated by that? I mean, there's somebody, one of our companies is really transforming the way women buy innerwear in tier 2, tier 3 towns. The entire buying process and the kind of quality of material. I mean, as we speak, the dress sense of tier 2, tier 3, in tier 2, tier 3 towns, women is changing, right? Here's a guy out of college who's building a robot which engages with, at an emotional level, it can read emotions of kids and react and teach them differently. We have a company, again, alumni. He's building India's robotics to transform the warehousing aspect of things. So there are so many stories, so many remarkable ideas, so many great personalities that, the entire picture really gets me going on a daily basis.
Fantastic. And John, do you want to share another particular story with us, or just go with the alternative protein?
That's good enough for now. But I think like everyone, you do have your favorites. Very briefly, I'd say one of my favorites is I was sitting one night with a neighbor in my condo here in Singapore. And he said, I so envy you. You get to work with all these startups and everything else. And he said, and I'm just working in this boring law firm. And I wish I could do something in the startup world. And I said, well, have you got a startup idea? He said, yeah, I want to figure out how I can actually do risk management using AI and whatnot. I said, well, why don't we just take a weekend at your house and build a prototype so that you can show people and we can get it going. And that company is now going for its Series B, and it's moved to Cambridge, England, and it's one of the fastest growing legal tech startups in the world. And so one of the things I love about that story is he just had the guts to move from working in a very, very very high paying job, but he went with his vision and he went with what he wanted to achieve, and now he couldn't be happier and he couldn't be more successful. And so I love that story just from the personal sort of arc that's taken.
Beautiful. And I think that's a beautiful story. If we could take a moment to shift gears from founders to funders, would you mind sharing with us, what have you learned as a funder that's made you a better VC? Silence reigns over the internet.
Chris.
Oh, yeah, Chris.
What we found in terms of the founders that generally tend to get backed in this side of the world is the ones that not only have the vision, but the ability to really work with people. And what we talk about is two other sources of capital. One is the human capital. The reality is in this developing ecosystem, just like all other ecosystems, the war for talent is on. It is serious. And if you don't do a really good job, Gojek, GoTo, and, deservedly so, will triple the salary and it's gone, right? So one of your key jobs is to have those interpersonal skills to not just get the investors, but just get the teams, get the customers, and of course, get the ongoing investors. So definitely, and particularly early, I mean, you're backing an idea, but you're not just backing an idea, you're backing the ability to execute, right? And it's a bit of a misnomer. When you're investing in a tech company, you're actually not really just investing in a tech company. You're investing moreover into actually a talent company and a human company, right? And the reality is, even when you look at tech M&A, right, which is the ultimate investment in a tech company, they are acqui-hires. No doubt about it. Half the time or more than half the time, it's not just the product that they've built, but the person that's built the product, right? These companies want the architects that have built this. So definitely the founder, EQ, human capital, political skills, that's definitely what investors look for and what they back. Markets are uncertain. How they'll react is uncertain. But what they're banking on is do we have this robust founder that's keen on a mission and with the human capital to execute?
So the founder and the team are of prime importance. Ashish, since John called on Chris, I'll give him another couple minutes.
Sure. I think, obviously, the investment area is a bit like wine. You just get better with age. So the more you practice it and the more you learn, I think the better you get. So your question was, what's making you a better investor? I think the first thing I would say is that we started off, and I think we still believe in it, that given how early the ecosystem is in this part of the world, you need to have an ecosystem approach. It's not just about capital. It's about bringing the network, bringing mentors, bringing expertise, opening doors. That's important with these companies, and many a times that can play a very, very critical role at critical moments in the company's progress. The second important thing is, while venture capital by definition is supposed to be patient capital, very often it's not. You want to see unicorns by a few quarters, and I get constant pressure from people and say, how many unicorns do you have in your portfolio? So I think you do need to be patient. It takes time to build good businesses, and if you have the conviction that the vision is right and the founder is right, then you must stay the course and you must back the founders. It's sometimes hard to run. I think we have given up that approach to just run it on an Excel sheet, to say that we don't have that approach, right? That where you say, I have 50 companies, each of them have a probability, and then some will succeed, 10% will succeed. And by the way, at any point in time, I will never know which that 10% is, because on one day it looks like this is my 10%, and after a year, it's completely different. So it's important to be patient with things and see them evolve and back things as long as they are progressing in a direction and maintaining some kind of a position in the industry. I think the third important point that I would say is kind of mirrors what Chris was talking about is the team. And I think we have become more and more sophisticated in terms of how to look at founders and founding teams. Lots of lessons for us there. So the first thing is I always expect the founding team to be the CEO, to be a chief evangelizing officer, which means that he must be able to evangelize his idea and concept to recruit the best talent, to get into the doors of some of the anchor customers, and to go out and raise capital with charm the big investors. So you need the chief evangelizing officer, which is very different from the corporate CEOs that we know. And I think from a team perspective, again, it may be cliche, but the need to hire great talent, particularly in this kind of a market where talent is short, for startup talent is short, right, is really important. I mean, sometimes people, I've seen many companies, they grow well initially because they know how to build, they can get to $1 million, but their people don't scale. The leadership does not scale. So it's all about how the founding team can really scale as the company grows bigger and bigger, which means that the individual must have the capacity to learn dramatically, be passionate about what he does, and be really good at recruiting and building teams and evangelizing. So we spend a lot of time with founders, and while everyone has their way of looking at it, I think we spend a lot of time intensively looking at the characteristics of the founders and evidence that they have some of these traits before we go and back them.
If I could pull on that thread for a minute, Ashish, do you normally find that the founder at some point along the development of the company drops off because it's becoming too much like a corporation, like a big thing? Or do you find the founders generally can make that journey all the way through to a huge established company?
That's exactly the point. I mean, even if there is one of the founders who can make that journey, there are several times that some of the co-founders can't make it, or they get burnt out, or they are not their thing is innovation rather than scaling. They get their kick out of creating the idea and the product.
Yeah, they want to make more new stuff. They don't want to scale up the things that they make.
So I think you do have the challenge, and founding teams must recognize it, and it's the job of the investors and the board to really feed back to the founding teams what they must do for the next leg of the journey. And again, going back to the ecosystem point, unless you have the mentoring talent and the expertise and the ecosystem of founders where they can learn from each other, it's going to be very hard. I mean, you can't sit as an investor in the board and say, hey, actually, I need you to do a psychometric test for me and let me change this behavior and that. It doesn't work like that, right? So I'm making a joke of it, but it's really a serious journey. And I think the better and more equipped founders, the more personally aware they are, the better they will become, right? Yeah. So those are some of the...
To hop in there, I'm sorry to hop in prematurely, but one of my favorite quotes from a founder I worked with was, I wish that I had fixed my character problems during my MBA program because now they're all embedded in my company. And I'm looking at them every day on a big scale.
True.
So it sounds like as an investor, you push to keep the founding team for the whole journey, or do you sometimes find that, no, they're happy innovating, let them drop off, you're happy to get a new team?
You got to be, so there's a fine balance. There's a fine balance as an investor. First of all, in terms of, most of the time we are lead investors and we are at least active investors on the board. There's a very fine balance between when do you step in and when do you step back. It's not our company. We don't run it, right? But at the same time, you must know when to step in and what messages you must give to the founding team at what point in time. Sometimes those are tough messages. They're really hard messages, but you must give them. Therefore, the ability of the investor to talk, to have a direct relationship and be able to talk very transparently with the founders is important, right? And at the same time, I think I spoke about the need for patience, right? you can't drop founders or founding team members because they're missing a few quarters. I mean, you really need to study the underlying reasons of what's going on, right? And at least that's what we stay with, right? But at some point, if it's not working out, and there are cases where it's not working out, you got to sit with the founders and say, look, it's about time that you think about how you're going to take a back seat and let other people lead from the front for the next leg of the journey.
Yeah, makes a lot of sense.
And,
John,
and that's why, sorry, just to close that, that's why I think that unlike other asset classes and even private investments, venture investing is a much more involved game. You're spending far more time with your portfolio companies on serious issues that unless you're observing it closely, you cannot sit back and in a quarter or in a half year, look at performance and look at what valuation is and take decisions on an Excel sheet.
So you got to be involved, continuously involved with them. Very cool. Very good advice. John, what have you learned that's made you a better funder?
So continuing on a theme, I again agree with what my co-panelists are saying, but I'd say the thing I've learned really is to look out for cultural fit, and by cultural fit I mean if I have a particular way that I like to invest or engage with people or whatnot, it's foolish for me to engage with people that I don't understand or can't work with or are interested in a quick flip of something if I'm patient capital. I think there has to be a fit with what's going on at the startup and what's going on at the investor level. And I think the thing I've learned as well is that you've got to be very aware of how people are slotting into the culture of the startup you're investing in. Because if you invest in a startup and suddenly you find that you've got 4 very different individuals, none of whom see eye to eye, you've got a world of trouble on your hands. And the best startups I know are the ones that are led by 1 or 2 people who set a culture within the company, who hire well so that people around them understand the pace at which the company is going to work at, what the future aspirations are. It's a bit like a marriage, right? You have to understand each other. You have to respect each other. There has to be this camaraderie. There has to be this singularity of purpose. And so this is why whenever I'm at a conference and someone says, "Oh, we're just going to take the founder out and replace them with someone who's going to do this," I'm the guy saying, "Hey, it's not that easy because that guy's built a culture. And yes, they may have some shortcomings, and so this is where I think the people that are a bit more experienced, possibly from the Valley and whatnot, when they helicopter someone in above a Larry Page or above an Elon Musk, if there is anyone could sit above an Elon Musk, but when they helicopter someone in on the top there, what they're recognizing, I think, in doing that is that there's a culture that's already there, whether it's engineering first or money first or 15 years to money, whatever the culture is, they don't want to mess with the culture. They just want to put some adult supervision in on top of an existing culture. And so I think the thing that I've learned is not to be too hasty when it comes to founders. Look for ways that you can work with the culture that is there to make that culture better, to make the people perform and augment things rather than go for too radical changes. Now, I agree, by the way, sometimes, as Ashish just mentioned, there are times when you just have to take radical action. But as often as that works, it doesn't work. And so that's the big problem with the radical action is sometimes you think you're fixing something and you're just creating another set of problems. So for me, the big learning over time is find a culture or find a company that's got a good culture and someone who as a leader, you can see is genuinely creating a culture that can build and scale as a culture, not just as a set of people that are going to report in on some abstract reporting chart.
Very cool. So it's not just this set of people, you're building a culture and that company is going to live on and grow. Before opening everything up to question and answer time, I've got a burning question that you guys ignited from our earlier discussion, and I really want to ask this, and it's a toughie. So I brought up the idea of when to scale, and brought up the old Clay Christensen idea of no. Make sure you're profitable. You get profits before scale. And then John piped up and said, "I couldn't disagree more."
can I throw in my 2 cents? Because
No,
I think
I want a lot more than 2 cents out of you.
right. I'm going to give you 3 cents. So my sense of this is if a company is profitable and they're distributing dividends when they should be spending that on gaining more customers and growing faster than they currently are, that would really bother me as someone who's invested in them. If I'm giving someone capital, I want them to I want them to accelerate as hard as they can. I want them to be Amazon. I want them to be brutal with their shareholders until they're not. I want them to be Apple, the same thing. I want to see a really, really strong growth path. And at some point in the future, we're going to see the share price go up, and there's going to be a huge cash balance there that potentially can be paid out in dividends. But going too early into profit territory, and I think is a huge mistake. And one of the biggest things I see happening is angel investors will put in some money, and then they'll say, "We want you to be profitable in 18 months." And it's the worst possible thing they could be focused on. What you want is a really robust business in 18 months. You want to see it really growing hard. You don't want to be seeing it losing money for no reason, right? I had the opportunity of investing in a company once. It's a ride-sharing company that's 10 times more capital efficient than Uber, for example, and it's in exactly the same business. I would much rather invest in that company than Uber because they're just more capital efficient and they're smarter. So there are limits, right? But broadly speaking, I don't want people sitting on top of profits. I want them spinning capital back into the business.
So then, for those of us who, sorry, I'm going to attack John for a moment and then ask them.
No, Ashish, let Ashish or Chris attack me.
No,
really,
okay, I think they're ready to attack.
Go, Ashish, and then I'll ask.
I think maybe I'm actually on John's side, even though it came out differently. I don't think we need to be profitable. We can't look at profitable ventures before we invest. But I think depending on what stage you are investing, obviously the angel, there's no question about profit or anything like that. But depending on what stage you are coming in, you need to start seeing the building blocks of things.
Yeah.
So my point the other day with you, CJ, was one of the biggest things that people ignore in the VC investment space is capital efficiency, right? And because there is so much of let's say, focus and vanity on raising larger and larger rounds at higher and higher valuations, that the entire idea of capital efficiency is lost. And by the way, in all the financial asset classes, VC investments is probably the only space now which seems to disincentivize capital efficiency in the short term.
Yeah.
But in the long term, what we have seen at the fund level is, if you are, like John said, if you have a company which is slightly more careful about how they're deploying capital, rather than finding ways of spending it, then instead of getting diluted by 200 times or 150, being left with 25% of where you started, you could be left at 50 or 60% of where you started, which means automatically you're making a 2x more than the other company. So I think that point is overlooked. And once you start respecting capital efficiency, then you start asking the underlying questions as to where does capital efficiency and at what stage does it come from? Obviously, you don't want to sacrifice growth of profitable customers by not spending money. But it comes from a better product market fit. It comes from ensuring that you have something differentiated in your offering where you can charge a margin. It comes from having a unit economics from where you have even more confidence to scale on the marketing side. And by the way, having said all that, there are all kinds of businesses. In some businesses, you need to spend money crazily because it's a winner-take-all business. But in a lot of businesses, it's not like that. So I think the problem with the business paper headline of here is the company that raises so many million, hundreds of million at so many billion valuation, and it misses out. And by the way, then that becomes a theme to emulate for everybody is just not true. You need to look at what's good for your business and how do you spend capital efficiently to finally grow and build a great company.
So scaling before profitability, would you think that's, so I remember the dot-com crisis. Everybody was in a land grab to scale up quickly. Profits were not the primary motive, and huge amounts of money went out from VCs to get eyeballs and get market share, et cetera, before there was any profitability. And Warren Buffett at that time said, no, I'm not investing in any dot-coms because I don't get it. I don't see the profitability as a solid business model. So do you think that what you're recommending could lead to another crash?
No, if it was, if it is a winner take all business,
yeah,
which by the way, only a small percentage of all, ventures are. I mean, it could be maybe 20% of the ventures. I call it small, but not all ventures are winner take all businesses, because fundamentally not all industry and opportunity, or not all industries are winner take all, right? If it's a winner take all business, it makes sense to invest before to get eyeballs and to get scale, right? Provided that you have an offering where customers are sticky. There's no point in getting customers through the front door and letting them go out of the back door, right? But there are lots of other businesses which can become equally large and valuable, where you need to see at least evidence of, let's say, some gross margin. Not profitability, but some gross margin before you start pumping in 10x or 20x in your marketing budgets. So that's the point I'm trying to make. I mean, there are different strokes for different folks.
Chris and John as well, do you want to hop on before I open it up for general Q&A?
John's smarter than I am, so I think he should go first.
I'm good. I think I had my piece there. Let's go for Q&A. Let's see what the audience has got to throw at us.
Okay. All righty. If anyone would like to offer us a question, I've got my chat window open. Just go ahead and type it in, or I will try and scroll through your pictures if you want to shout it out, raise a hand, and so forth.
So a couple of comments whilst we wait for the questions. If we look at the 1900s, you had the supply side monopolies. In the US, you had Standard Oil, you had the rail, and there was a breakup there. When we're in the 2000s and we talk about the digital transformation, we are in the age of the new modern monopolies. And these are the platform economies, the network monopolies, and the whole 1990s, early 2000s was about eyeballs and building these networks. And the belief at that time was that if you invested in these companies, you'd build a defensive moat, and it was great. There is still that belief, but now it's the stage 2 of that belief. And when you talk about profitability versus scaling, it's scaling as long as we could see the clearer path to profitability. And let me be very specific here. So right now, the conversations around you're loss making, but are we seeing lower cost of acquisition, lower cost to serve? I'll be very specific here. Are you seeing more profitable customers that are coming back to you? Are they sticky, right? And that is what investors are piling up in. So you really got to look past the numbers. Are you getting the sales because you're purely paying for it, and basically you got a VC subsidized marketplace going on, right? And those days are over. It ended around 2015. That's what we did see. 2015 and afterwards, we are seeing a very healthy wanting to back these companies, pay a premium if they are getting to that path. And there, in Southeast Asia particularly, I'll make a nuance. When, Clayton Christensen talks, he's also covering deep tech companies. And deep tech companies, you have to get it right. There's no margin for error. If you're building a car, you have to get it right. If you're peddling out medicine, you have to get it right. But Southeast Asia is mostly a consumer tech, a more B2B to SME kind of landscape. So there is that margin for error. You don't have to perfect the product. What you care about is, are you getting to build that network company of scale? The other thing that's helping with investor conviction is you got the global players that have come in and they've seen these models work in the US, China, and India now, even Bangladesh and Pakistan, and they're like getting patent recognition. It still works.
Fair enough. Fair enough. And we've got a question now from Anu Gupta.
Thank you so much. Great session, guys. So my question here is, okay, I mean, the business is obviously making relationships. So what does it take and what's the best way to build connections with investors? If you're a founder, what's the best way to do it?
So I got a story. So I'm in block 71, right? On the ground floor, very clearly says Hatcher. People know we're a venture capital company. I've been there almost 10 years. In 10 years, I've had one person knock on my door and say, "Are you a venture capitalist?" And I said, "Come on in, let me buy you a coffee." One guy, right? Now, he had a really crap idea, unfortunately. I'm sorry to say, I wish it had been a real money spinner because that'd make for a better story. But the essence of my story is we're here, right? And I think 90% of the secret is just reaching out. We're on LinkedIn. You can find all of us. And quite often, if you're just persistent, we kind of appreciate that. Do you know what I mean? If someone's got such confidence in their business that they're not going to take no for an answer and they're going to insist on getting a meeting with you, that's going to be an indication of how they are in a sales environment. So I think that early reach out to an investor should be seen as a proxy by us as how well and how persistent they're going to be with propagating that or executing their business plan.
Thank you very much. While we wait for more questions, I wonder, you've been giving some great advice to founders and funders as well. Is what you're saying different for different industries, different geographies, different stages of the company development, or no, it's blanket, this is for everyone you deal with?
It definitely changes. So if you're a founder and you're seed all the way to maybe Series A, B, just never use a banker, because basically VCs think that if you need a banker, you're a crap company. So you always use the direct approach.
And this is coming from a banker, right, Chris?
Absolutely. Yeah. And if you're B2C, then you do use a banker, because what you are in is a growth stage. It's institutional. It's a different market. So you got to understand the different stage and, what you're trying to achieve. I have a different view to John in terms of being persistent. You need to be persistent. But what I do find is that there's just so much noise and people are getting really annoyed with the noise. And so what I found is it's, again, trying to find that fellow founder, because a founder has raised before, they understand, and most of them are pretty nice. I want to reach whatever it is fund. You have been invested by them. How are they, right? And most founders will be okay. Oh, look, man, they're looking for this. You should do this, blah, blah, blah. I mean, the good thing is, in general, I've found founders very helpful to other founders. And you should actually make sure that you do your homework so that when you do reach John, it's like, actually, I've done my homework, John. I know your time is important. John, this is why you should invest in my business. And John, I'm not going to bug you 10 times because pure persistence is going to work. I just find that relationships and relevancy works.
Yeah, definitely the reference matters.
So I think we've got a question now from Michelle, followed by Amit. Michelle?
Hi, thank you, Dr. CJ. I've got a question around the kind of support that you give founders in their personal growth and their companies. And I think some of it has been addressed by the culture topic that John had raised. And Dr. CJ, you talked about the character thing, right? Amplified in the company. And I'm looking around our group and I think for our race friends, Marie, and also our enterprise SG friends, I think a lot of times we speak to founders who are in their own world. I mean, it's human nature to be blind to our own shortcomings and gaps. So how do you go about doing that? Talking about what is lacking objectively and the skills and the business is it's okay, it's clean, people get it because it's logical. Where it comes to the other aspects that's a little bit more emotional and human biases come into play, how do you support the founders' growth and also help them with the growth of their companies?
Let me take a crack at it, since we have been at least trying to deal with the problem. I don't know whether we have a perfect solution, but at least we are taking a few steps in that direction. So we strongly believe in that, supporting founders and teams in their growth. And ours is an ecosystem approach, and we find 4 or 5 things that we could help founders with, right? One is just strategic advice, which I think domain knowledge, how to grow the business. And I think they need less of this. It's more bouncing board, right? The second is I would say, networking kind of requirements. I want to meet somebody from this industry. I want to meet somebody from this company. Can you connect me to a potential CTO candidate? So on, right? The third is also very, very domain specific, very domain and very specific idea. How do I build a community on LinkedIn, which becomes a source of deal flow for me? I mean, where some of the tech guys will have that. I mean, they have not done digital marketing. So something very specific, right, with regards to a domain. The fourth is around coaching, which is the kind of things which are the toughest and the most unseen. I mean, no one has time to, or even to realize that these are the shortcomings that me or my team has, and to express them and to have that. So I think it's one of the most important things, like I spoke about scalability of the founding team, but it's a need that is the least expressed and the least visible, least overtly expressed. And I think the best way to do that is really to get the founder to speak to other people who are successful in their journeys and learn from them. It also helps if the founder trusts you. If you are not the VC who is just banging the table and or maybe showing up to the meeting which is unprepared or completely clueless of what's going on in your business and what's going on in your life. So as a VC or a board member, unless again you are connected to the business and the founders, you will not have visibility of the problem. So once you have, that's the first step. And then once you have that, then get them to meet people who might be helpful in that journey without being, you don't have to clearly say that, okay, these are the areas of growth. It's not like a corporate style evaluation on where are your growth, your growth areas or areas of improvement. It's more about continuing that conversation and finding, getting the entrepreneurs to find answers and meet people to find the answers. I think that works well. And sometimes you can parachute the really experienced founder into the position of the mentor. We have a formal mentoring program, by the way. We appoint mentors to every company selected by the founders themselves. And in those cases, if they really hit it off, then you can see some osmosis happening between the mentor and the founder. So those are some of the things that we have been experimenting with. It's worked where I can't say it's a perfect formula to work, but it does work. And again, a lot depends on the people involved. So it's case by case.
Thank you, Ashish.
John, you've got the yellow window around you. Do you want to add to that?
Well, no, I can't improve on that.
Okay, super. Amit, if I can beg your patience for a moment. Yeah. I want to finish off with your question, but go to Marie's right now.
So I'll go ahead first.
Yes, please.
Okay, thank you. Thank you so much, everyone, for your sharing. I think it's definitely good insights, and yeah, good to nitpick on the VC's perspective. Just a quick introduction from myself. I'm from Singapore Center for Social Enterprise, in short, WASE. So we are the ecosystem developer for the social enterprise scene in Singapore. Yeah, and I think there is a rise of interest in ESG investments, right? Not only from institutional investors, but also like PEs, VCs, and all the family offices. Yeah, but I think I would just want to ask for your insights on what's the VC's take on impact investments. Like investing in startups that do good, that has a social impact or environmental impact even. Yeah, do these startups actually like appeal to VCs of your kind? And yeah, like I guess in this case, like these startups, they can also be labeled as social enterprises, right? And yeah, I just wanted to nitpick on your perspectives as well. Yeah.
I'd love to take that one if I can. First, to crow about something that happened last week. We won second place out of 475 fintechs around the world, including a number of VCs at the UBS Future of Finance competition. And one of the reasons that we scored highly on that is that we were contrasting VC 2.0 with VC 3.0. And we talk a lot about that in our blogs and other things. And VC 3.0 we see is a completely different animal than 2.0. VC 3.0 it's fast versus slow, it's automated versus manual, it's AI versus all the other things that go into it. It's interconnected versus siloed. There's just it's night and day. It's going to be a very, very different world. But one of the things that's very different about it as well is that impact used to be an add-on. It was a nice to have. It's something we'd think about. It's something that isn't that cool. Not anymore. If you talk with any family office with any amount of money, particularly post-COVID, everyone now wants impact at the core. They want there to be ESG or to be impact metrics that can be measured alongside the investment. So people are talking about constantly the concepts now of triple bottom line, of measuring, of measurable commitments to the world. And by the way, as a VC, you must beware of non-impact investments going forward, things that are doing bad for the world, right? So it's happening both sides now, but what we're seeing from investors, our LPs and other people that work with us, is that you cannot ignore impact anymore. It has to be part of your scoring process, your assessment process, and you've got to take it into account. It may not be relevant for every investment. If it's an influencer channel on YouTube, it's probably not going to be relevant, but you really need to take it into consideration for most of the stuff that you're going to be looking at. So I think it's part of this next wave that we're seeing. I don't know if everyone saw the Sequoia announcement today, but if you didn't see it, go on Google and have a look at what they're doing. Have a look at the other announcement yesterday on PitchBook on what's happening in VC. There's massive amounts of capital moving into VC now, and a lot of it is going to have an impact ticket on it that's going to be very much part of that investment philosophy.
And I love how you put it that that's going to be the default now. And we're going to have the term non-impact investing.
Well, there'll be like there always is, there'll be some dinosaurs that hang on to the old ways of doing things, but impact will have to be considered. And you may have to actively say, that's not a component of this deal, but it will be part of the measuring and scoring and assessment process, undoubtedly.
Absolutely. I hate to cut you guys off, but we are technically out of time, and I do want to give Amit a chance to ask his question for a quick final thoughts from all you guys. Amit?
I just wanted to, add some tough questions for our friends here. I mean, we know each other really well. We're all very proud of you all as our charter members. And I know you've made some really big bets, very successful bets. But I'm also sure there must have been some mistakes. Anyone want to volunteer sharing what some of your biggest mistakes might have been, or your biggest mistake?
No, I can go on that one. It's kind of a very long list, Amit, but let's start. I think one of them is to we missed on a few biggies. We were offered the chance to invest in Swiggy, and we didn't, right? And there was a reason for that, and it was basically that we were a small fund at that time, and we just didn't have the wherewithal to be able to support that company. We could have taken a position, and a small position, and just stayed with it and get diluted, but sort of we didn't have the wherewithal to say that if he comes back to us in 6 months or 1 year and say, can you double your bet or triple it? We didn't have the capital. But I think in retrospect, if we hadn't bothered about those things and just gone in and, it would have been. So we have a few cases like that where because in Fund 1, we were really small, we couldn't take some of those bets. I think one of the big misses for us was absolutely one of the pioneer companies in the agri-tech space, a company called RML, which was a spin-off from Reuters. It's quoted in, I think it's quoted in London Business School, Harvard, and case studies. It was ahead of its time, and we were very passionate and wanted to build it through. But again, it was one of those early mistakes where I think we realized after we had gotten that an industry like agriculture, the government can play a key role, and many a times, for all the monopolies that we want to create, and we hope that all this will create, the government can really step in and say, as we have seen in China recently, and say, hey, nothing doing. So many sectors which are influenced by government, even though they have potential to be, really big. I mean, in the case of education in China, we saw that clampdown. Education, maybe healthcare, maybe agriculture. Those are things that are more politically sensitive and prone to government action. So I need to be a bit careful about those. And in some cases, it's been, most of our mistakes have been about, misreading the founder. That's all. I think almost always it's been, we lose very few companies, so we have a very high hit rate for the space that we get into. But almost always it is about misreading the founder.
Yeah, no, thanks for that, Ashish. I mean, I know that you've had some exceptional exits in the last 12 months, your companies. So clearly there's a lot of rights than mistakes there. But thanks for sharing.
We're 5 minutes over time. Sorry for that. Chris and John, do you want to slip in a couple mistakes, or shall we call it a day?
We were offered 5% of Bolt for $500,000. 5 years ago, that 5% is now worth whatever 5% times dilution of $5 billion. That's mine.
Wow, good one.
We'd run out of money as a fund, so we didn't have the money to invest, but it's still pretty painful to look at the share price.
Chris, quickly.
My mistakes will take at least 5 days to go through. So
Thank you, everyone. Great session. I know I learned a lot, and I hope we've shared something insightful and useful to the rest of the audience. Thank you all so much, and I look forward to seeing you in the next fireside chat.